Now we're going to shift more into the U.S. and what is happening within our markets in general. And the one benefit that we're seeing here, again, we use Bloomberg data, we use other data that we track, and then this is one that comes from the Oxford Economics Group. And here you can see that they have the recovery in terms of the U.S. at about 80.5% as we headed into the beginning of Feb. That has since flatlined for the most part, but again, we're still seeing this activity indicator that is still moving in the right direction. The biggest problem overall for us remains that mobility side as well as the demand side, because that's where we see the biggest struggle. Health is starting to get better. Obviously, cases are down, hospitalizations are down. They're starting to flatline a bit. We're starting to hit this little plateau, which could continue to go lower. We're expecting a little bit of an increase in March. Just hopefully it's not too bad. But again, the net benefit is we're still not going to see these lows from 2020. But again, we're still not also seeing those rally back, and that's where we try to get a bit more specific as to, well, what does that mean and what are the biggest overhangs that we have to overcome? Because we do have some really good data and we have some troubling data, and it's just a matter of which one is going to weigh out over the near term. Now, for those that have paid for college, you will be happy to know that U.S. college enrollment for the first-time undergraduates declined at the fastest pace in a decade last year. And that's according to the Federal Reserve. And here you can see enrollment declined by about that 13.1%, going down in general. And it, as we've talked about on this show and other shows in general, we need to look at what is the best way to reduce the overall cost, because inflation on the college level has just gotten out of control. And this is starting to have people think differently about, well, what is is there an importance of a college education? Is there a cost? What is my rate of return? And here's something where we're starting to see that factor in. I mean, I don't know if you've ever had a plumber or an electrician come into your house, but it is at least $200 just to enter the home. So we need more skilled labor, and you can do that at a 2-year school or at a union shop or as a apprentice. There's a lot of opportunity out there, and there is a need for it. And as we'll talk about, some manufacturers are struggling to find qualified individuals. So it's not so much that there isn't jobs, it's just who is qualified for that job. And here is just an example where everyone's gone to school, gotten a liberal arts degree, but again, it comes down to, well, what am I going to make off of that in the longer term? Now, when we shift that a little bit, college returns decline. Again, this is an endowment issue, as the endowments have had to pull from their funds in order to keep the school funded, just given the amount of impacts that they've seen on PPE, cost increases on that side of the equation, and you just have less people coming in, which means that you're going to have to cover some of those costs until you can start to normalize them and bring them down in general. Now, when we just take a broad stroke, and we're going to pull out some of these different components to highlight why they're good or bad and what do they mean. So when we look at the composite, PMI, it was all positive in terms of coming out better than expected. Manufacturing is flatlined a little bit, but services made up for that. So on a net, it was a net strong move. Existing home sales, can't stop, won't stop. That's a net positive in general. Then when we look at the Chicago versus Dallas, some of those are positive, some of them are a little bit negative, and it's going to be a matter of what is driving the future. And on the positive side, there was really a lot of near-term current conditions was all very good. But on the future expectations on that side, things were starting to soften. New orders were down, prices are going up, and then the ability for them to recover those prices is shrinking, which is just going to hurt that margin. Then when we look at just the core logic, the 20-city increase in pricing, as the homes go, so do their prices, and they continue to grind higher, again, driving some of that components that we talk about on the back end of inflation, as those rents are going to continue to push higher. Then when we look at consumer confidence, we're fairly in line. We're going to talk about the bifurcation within that on those at the higher income versus lower income, and why the numbers are netting out to be positive. But it's really being driven by the highest quartile as the middle and lower continue to feel worse about their situation. Then when we look at new home sales, it bears repeating. They are very strong across the board, single family, multifamily. So again, there's something to be said about just that side of where things continue to go. Housing remains robust. How much will the rise in the 30-year start to impact that is a question that we have to consider in a bit more depth, because that's where we're starting to see rates creep up, and the Fed is trying to offset that by buying mortgage-backed securities, trying to keep those rates down. But again, these are things that we want to look at in a bit more depth. Now, when we consider the Federal Reserve receipts and outlays, you can just see the amount of receipts that the U.S. federal receipts have been. That we've continued to put a lot of capital into the market, and we're not receiving as much. And this is just showing you in a different way what the shortfall is and what the deficit is going to be, and what has to be made up in the debt market, because you have to go out and make up that difference. And you could see back when Clinton was president, that was when receipts were actually above our outlay, and that was when you continued to see some of the balancing of the budget. But now that has widened out, and we haven't been able to close the gap. So each year it's compounding on itself, because not only do we have to roll the debt that we currently had, we have to increase the amount to make up that shortfall, and you can see just the amount that's going to have to be made up. So let's just put this in a quote here. The U.S. Treasury Department said Wednesday the deficit from October through December totaled a record $573 billion, a 61% increase from the same period a year earlier. Federal outlays rose 18% to $1.4 trillion, driven higher primarily by automatic safety net spending such as jobless benefits, nutrition assistance, healthcare. Total receipts held steady at $803 billion, the Treasury said. So again, we're going to have some problems. But as all of this liquidity rolls through, the Fed is looking to purchase the TIPS, which is just those Treasury inflation protected securities. And they want to try to manage the inflation story. And here you can see just how much they're buying of the TIPS market, because they know as inflation goes up, these are going to get very expensive. So they're trying to take this out of the market, again, managing what those expectations are, trying to protect what that inflation is going to look like in general. When the Fed is doing as much as it's doing, what do we have? We have Graft, we have all of these problems, and anyone who follows EFT or Energy Financial Twitter can attest to we are very attuned to SPACs or the special purpose acquisition companies. And here you can see just the amount that has come out, but not only just in 2020, but what has come out in 2021 to kick off the year strong. This is it's something. I don't know what it is, but it's something. And does this mean we're closer to a top than a bottom? Maybe, but this is definitely an issue that is reverberating through the system as free money remains very, very open, and is, again, I think has to be watched very closely to see how much people are going to be impacted. What are they? What is the value that they offer? But again, as the liquidity is available, so will the people who try to take advantage of it. Now, we talked about this in the first segment. Just want to reiterate, just looking at only the U.S., and this is looking at the 10-year, you can see, and it's probably moved even since I took this Wednesday morning, you can see just how quickly those inflation-protected securities have bounced, after coming down from, let's just call it from September to the end of the year, and we're starting to see that reverse higher, and it's really being pulled up by the 10-year break-even inflation rate as it sits at that 2.3%, which with the U.S. generic, which is just looking at the index, pushing up as well. Again, the whole curve is shifting higher. Bid to cover isn't there. We've seen some of the rates that are coming across in the auctions coming off at the higher end or even above the top of the range. Again, these are things that are a concern, especially as we go into the end of the year. And what does it mean? And this I thought was a really good chart. I know Sankey put it out there, and it's from some research notes. And this is just looking at the correlation of the U.S. Treasury 10-year real yield to the underlying assets. Now, this breaks down. There's short term versus longer term. Some of these things can move in tandem and then break down over the longer term. It's always important to look at correlations. What are the underlying correlations that we're seeing? And typically the DXY is going to be the closest because people are going to purchase dollars to buy treasuries because you have to buy them in dollars. So you'll sell your local currency, you'll buy dollars, then you'll purchase the treasury. And as those yields go up, it's going to attract more and create a positive carry, which just means that it makes sense to sell euro, to buy dollar, to buy treasury, or pick your currency. And that's typically where we start to see that. And then as those move up, typically we'll start to see some of those benefits in general. Iron ore, copper, that's also as those real yields go higher, then they will also be a positive correlation because you're expecting more inflation. You're starting to see a bit more of a creep higher. That will pull things up. And then on the downside, typically we start to see energy and Brent just because on an average, you'll start to see a little bit of pressure on activity. People will look for other means of carry. So you'll buy a treasury and not so much energy. You'll start to look at what is going to be the cost benefit analysis. Gold is one that's interesting because it can decline. It can move in tandem, and they can also be completely bifurcated and inverse to each other. And at this point, it's going to, because of the situation on the balanced supply demand aspects, and that comes down to some of the materials, gold, some of these different assets, you're going to look at what is the supply demand, who is the net buyer. Brent doesn't have to be negatively correlated. You can see it's really close where it can be positive or negative depending on what does Saudi do, what does OPEC Plus do. You could create a supply squeeze as we saw in the 70s. In the 70s, you had an oil embargo and oil exploded. You can create a supply shortage, and even as demand stays flat or starts to rally, even though we have, let's call it 8 to 11 million barrels a day in spare capacity offline, that can also come in pretty quickly. These are things to consider as you're looking at best ways to position. I still think real yields are going to go up. And that's going to be something to consider as you're looking at where's the best place to invest. Now, when we look at the super cycle, clearly the spot price index hits the highest since March 2013. Everybody is not only just front-running inflation, but there's also real physical supply-demand problems. And the ones that I will focus on, especially in the last segment, is going to be grains, because grains is where for anybody who's been watching our shows, anybody who's reading our research, we've been saying grains from the beginning of COVID until up through last week, because grains, we continue to see a massive shortfall on the supply side, and demand is only going higher. The problems have increased, and we'll talk about that in the last segment, which is going to keep and provide a lot of support behind just what these shortfalls are going to look like. And that I still think is a best place to play that. Then when we look at just what is the PCE, which is that personal net worth, and the PPI service inflation, you're seeing some of the problems and why we think there's going to be that snapback. And just looking at just the services side, the amount of inflation that's going to come through as it gets priced in, and I can show you a million charts like this on how all of the leading indicators are sky high, and a lot of the Fed lagging indicators are just going to come up and marry it and match it. And you can see that there's a delay. Sometimes it doesn't exactly spike in the same level, but it always trends in the same direction. And you can see here, as the PPI consumer services went sideways, the PCE services came down a bit, and now it's just exploded to the upside, which is really going to pull this up. Again, showing itself in the inflationary side of the equation. And then when we look at the Philadelphia Fed leading lagging parts, when we look at the Fed leading lagging and smoothed over, I think this is a great chart because you can see just what the direction is. And these are the underlying problems that we currently have as we look forward. And it can snap back. We're obviously not where we were in the beginning of 2020, but the trend is moving in the wrong direction. And given the bifurcation in the market of retail sales at the top level versus bottom level, this is where we start to get concerned on what trajectory do we have, and which we think, and especially if we go back to 18, you can see that the leading indicators can drop first, and that just means that there's going to be a pause. And based on the data we're seeing, it's more likely that ISM manufacturing is going to go sideways for the next few, and then it'll start to move down as we start to get logistics normalizing, as we get inventories back to a comfortable level. That's when we'll start to see this come through, because that is a big component of those ISM manufacturing components. And as the service, as the timing delays normalizes, all of those things will help kind of drain some of that increase. And then when we look at just what is the leading indicators, and here you can see the leading index is taking a nosedive as CEOs feel really good. And typically there's a certain leading aspect to the CEO side, but there's also points where you can see they get a bit more excited versus what the actual leading index shows. It's never really been, it's been at this bifurcation before. If you look at 2005, you can see how the CEOs felt really good just as the leading index turned, but the leading index did what it was supposed to do. It led the view, and it actually was predicted where things were going to go. And that's where we think this is start to roll over, and you're going to start to see some of this softness or some of these concerns, which are cropping up in the PMI data. As exports and orders start to slow down, which will start to bring some of this expectations a little bit lower. Now, just rounding this out before we take a break and go in a bit more detail in a different direction. This is just looking at the cash shipment index. We had a 1.1% month-over-month drop from December, which was obviously the seasonal. So seasonally adjusted, the index rose 3%, which was the largest since September. This acceleration takes us another step closer. But as we've been saying, the leading indicators are starting to curve. And this is just showing what we've been talking about, where there was that nice spike. Guys were looking to increase their inventories, and now we're starting to flatline. Now, it's not rolling over. It's starting to flatline, coming down a little bit, trying to find this comfort level as we start to get back into a more balanced approach, and we can look at trade a bit differently. And unfortunately, trade is going to come under some pressure as we're seeing import prices increase, export prices increasing, margins getting squeezed, and just what is that impact going to have, especially when we go look at Asia. And this is just looking at that truckload index that we talked about, especially in segment 2. In January, the cash truckload line haul index measured per mile line haul rates, fuel and accelerated significantly to 7.3% year-over-year increase after a 1.1% decline in December. Consistent with the cash implied freight rates series, the acceleration came from both month-over-month improvement and an easier prior year comp. This seasonally adjusted index rose 2.3% in January and has now risen for 7 straight months, as we know from the trucking numbers that we talk about. Although there has been some slowing spots in rates and consumer spending recently, capacity remains tight. As diesel prices rise, this is going to become a little bit harder because we're starting to see some pressure come into, obviously, the inflation numbers as there's that rush to try to get as many trucks as you can. This is going to become a much bigger problem in general, and one to watch as we head into March, as we're starting to see some softness in the trucking side and just starting to see a little bit of softness on the trade on what's happening in the underlying what's the word I'm looking for, as we're looking at the underlying trade routes, which prices are still elevated, which is bringing down some of that flow through. And when we go into the next segment, we're going to look in even more detail as we start to talk about what is PMI, US GDP, and then what are some of those key components that are weighing on not only jobs, but also some of these inflation costs that we continue to see cropping up over the next few months.